Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's Friday again, and we get to contact with our listeners, and we also have some questions.
3 listener questions today. Actually, there's more than 3 questions, but 3 listeners have asked questions. The first question comes from our friend Michael. Hello, Jim and Bob. I have 2 questions for Bob. According to a recent Deutsche Bank survey, people in the U.S. between the ages of 25 and 34 will invest 50% of their stimulus checks in the stock market. People between the ages of 18 and 24 intend to invest 40% of their checks in the market. Bob, is the Fed put being replaced by the stimulus check put?
Hey, Michael, that's a good one. I wished I had a thought of the arranging the lines. It's good. Yeah, it's a sign of a craze in the stock markets where this sudden cash came in, where many young people were staying at home, and they then discovered the stock market, which is often the case at the peak of a terrific bull market, is when the general public gets in. And I've been saying that it's difficult to get the actual measure, but to my impression, it's the public participation is the greatest since 1968 and 69, and that was followed by a lengthy bear market. And then we had another phase of the question.
Michael also asked, Bob, there's talk that the bond vigilantes are galloping back into town, dragging up interest rates along the way. It's rumored the Fed may confront the bond vigilantes with Operation Twist, also known as OT. Bob, will the Fed, in the spirit of Wyatt Earp and his brothers, confront the bond vigilantes at the OT corral? And if they do, who will win this time around?
Oh, God, that's colorful writing. I love it. Yeah, Operation Twist was put on in the, when was that? 05, 07 period. And that was to prevent rates from rising and that sort of stuff. But actually, that was a reintroduction of Operation Twist. And for that, we want to go back to 1946, which set a secular low for interest rates, particularly as determined by long-dated treasuries. The low was in the order of 2.5%. Then it rose to 3%, and the policymakers started worrying about the obvious because the debt burden was huge relative to the economy as a result of the war. So the then interest rate cost, as rates went up, of course, went up and became concerning. So then they had the brilliant idea of the Fed buying bonds out of the market, buying treasuries, and that would prevent rates from rising above 3%. And then they went on, that began in the late 1940s. And then by the time you got out to when I came into the business in 1963, the interest rate was approaching 5%. And then by the time it got up to 6%, which was getting excruciating, this is where they started in the U.S. the first Operation Twist, and it was also based upon the popular dance twist that came out in 1963, I think it was, or 62.
Chubby
called
Checker.
The Twist, Chubby Checker.
Yeah.
So the Operation Twist was intended to lower interest rates, and part of it was buying, guess what, long treasuries. But the idiots didn't understand that they were injecting so much credit into the money markets that it was depreciating the dollar. So as the dollar went down, the interest rates went up. So their very exercise in trying to lower rates was actually raising them. And in the U.S., the rate for the long bond went up to 15%. And in a history of, you can say that there's modern finance really began in the late 1600s, and the highest for a good country like England on a secular high in long interest rates for the senior government was about 6.5%. And then in the 1700s and 1800s, a couple of times it got to 6%. So getting to 15% was extraordinary. So in answer to the question, the bond vigilantes have been at work. Interest rates are rising, and also adjusted for inflation, real long rates are going up. And that real long rates going up is a sign, or let's call it this way, is a feature of a post-bubble contraction. Real long rates going down is a feature of the bubble, and then the reversal to rising is a feature of the contraction. So we're watching this one very closely.
Justin in Berkeley, California asks, Bob always states that the central banks follow long rates and have very little control over those yields. With long rates going up, does Bob consider that a move by the bond vigilantes? There are insinuations that the Fed wants to implement yield curve controls by buying long bonds when the yield gets over a certain threshold. Is this really going to work?
Yeah. Saw one last year, Justin, that the Fed was not going to try and manipulate the yield curve. And then, of course, let's define the yield curve as the difference between long rates and short rates, particularly staying in one quality like treasuries. And but throughout history, and we have the U.S. yield curve back to 1857, and the observation is that every time the curve inverts, you get followed by a recession. And it inverted actually in 2019, and then the hit in February 2020 with the COVID flu and the shutdown of employment forced a recession. The recovery recently may have kind of canceled the recession. So, but nonetheless, the yield curve is still very steepening since December, and that's been a boon to the bank stocks. But what is happening now is that speculation in the credit spreads, which is the difference between high-grade and low-grade bonds, has become measurably excessive and is attempting to change. So the combination of the curve and now the credit spread is now a warning on the excessive speculation out there. The Fed is unable, or even before the Fed, when you had the Treasury system in the U.S., so on a record back to 1857, whichever policymakers are at the watch have been unable to affect the yield curve. So They will talk about it, but the curve and spreads are going to do what they're going to do, and quite likely heading towards a contraction.
And from Andrew, a little bit of a conspiracy theory thing going on here. In June 2017, the WHO, the World Health Organization, issued the first pandemic bond for $500 million set to mature in July 2020. The covered perils included the flu, coronavirus. Given the WHO stance on the beginning of the appearance of the coronavirus, encouraging borders to remain open, does this not give cause to Interpol to search their premises and take names so the court in The Hague may try officers of the WHO for crimes against humanity following the prolonged lockdowns that seem solely financially motivated so they wouldn't have to repay the borrowed amount on time and in full? Did you even know there was a pandemic bond?
I did see something about that, yes, but it seems bureaucratically inspired, and the question is dealing with what really can be done. And no, I like the term about crimes against humanity, but yeah, because the hit to employment is perhaps the most severe in history, where it was a deliberate decision, and it was largely done to try and influence the U.S. presidential election. And indeed, a spokesperson for the Democrat Party recently pointed out that the COVID was the best thing that had ever happened for Joe Biden. So it's been fascinating, and yes, I think that any contrivances based upon COVID are contrivances, and the boom that we were looking for in the financial markets and in the economy was likely to peak in this year. And then more specifically going back to October, when we had a moderate oversold in the time when seasonally stocks can be weak, so we looked for then a rally out to January, around January, and that it could become highly speculative. And we made comparisons to the raging mania for gold and silver that completed in January 23rd, 1980, and also to the huge speculation in the Tokyo market with the Nikkei bubble that ended at the end of 1989. And there have been many other terrific speculations that have burned out in the January window. And the speculation came in, and by rotation it took up things. It just like that GameStop was huge, remarkable stuff. And then it, of course, took the senior indexes with it. And then each of those specific speculations went straight up, then straight down. And that is typical of a major top in the stock market. So I think what we're looking for here is that no effort by the Federal Reserve or any other central bank in the past has been successful in keeping a raging financial mania going. And all of the excesses have become measurable. And we're looking for the end of speculation to be marked by a loss of momentum, which became apparent 4 or 5 weeks ago, and then taking out certain support levels, which has happened this week. So a lot of damage being done.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway.
Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Some headlines that Bob's attention was caught by. The first one, crude oil action has really heated up. What's behind that, Bob?
Oh, yeah. The hit with the pandemic panic into March was extraordinary. Remember, the front month contract went to minus, and then you had the rebound. But what has driven it since the election has been that the Democrat Party hates prosperity, and it hates crude oil and natural gas and gasoline and, all the stuff that makes for the good life. And so the street has been raising the crude oil price and gasoline prices and natural gas prices in anticipation of the Biden administration shutting the industry down. And this is indeed what is happening. They're doing it by executive order, a whole flood of executive orders, one of which was shutting down the pipeline construction, Keystone pipeline construction, which is important, and shutting down future exploration of oil fields that are held by the federal government. They have yet to shut down oil fields outside of the federal government, but these guys are crazy enough to do it. So the result is a strongly rising crude oil price. It's now on the weekly relative strength index. It's up to almost as high as it got in 2007, and that was on the way to $147. But I saw a forecast today it could hit 70. But it's worth noting that the relative strength is getting very strong. And it's also, you've had the huge price action in lumber, a wonderful rally in base metals, including copper, and those reached technical excesses and started to correct. You've had terrific rallies in the exotics, such as vanadium and cobalt, but we just kind of watch the ones you can chart and do the technical on, and excesses are being reached now. So we just watch for a sell signal on crude oil, which don't know when it's going to come, but when it does come, we'll advise our subscribers.
Another headline, troublesome trio in emerging markets. And those troublesome trio, Turkey, Brazil, and South Africa. What's so troubling for them?
Well, this is classic stuff, Jim, where in lesser exchanges, the central bank there suddenly find that they had a loss of reserves, and their reserve, and a lot of the important reserve would be U.S. dollars. So where this is important is that it happens in lesser countries before it hits the senior country. And I have a wonderful observation on that one, dating back some 2,000 years ago.
Let me guess, Cicero.
Roman writer Cicero observed then that if there was a trouble in the financial markets in the eastern provinces, meaning the east end of the Mediterranean, that they would inevitably hit the financial center in Rome. And we've seen it many times. It's just the way it works, where the lesser exchanges run into trouble. The party may continue in the financial capital, but eventually the sudden loss of liquidity will hit the New York market. So again, here's another one we're watching for, an ancient pattern in history.
And Bob, that pattern has repeated over and over, hasn't it?
Oh, throughout, yes, yeah.
So what worked for the Romans probably still works today. Well, that's why I always wonder, why do some countries have negative interest rates? Because it seems to me the ancient Chinese, Egyptians, Romans, they never had negative interest rates because they knew you have to make money somewhere.
Yeah. No, the negative nominal, that's your day-to-day interest rates, has never happened in history. And in Germany, the 10-year note got down to minus 0.88%, and absolutely unheard of. But the mechanism of that, at least to this viewer, is straightforward. The interventionist central banks and economists have a theory that if they inject credit into the market, it goes straight into the money market. It goes straight into stimulating GDP. Well, it doesn't, and because it goes into whatever the public is speculating in, and for the last decade, the speculation has been in financial assets, stocks and bond prices. So what you've had here is a bogus theory being relentlessly applied in a period when the speculation is in stocks and bonds. So it bid the price of German 10-year notes so high that you ended up with a negative yield. Absolutely unheard of. And without that unrelenting application of a bogus theory, you would never have had negative nominal. But hey, this is as extraordinary as in 1980 when the speculation was in commodities and interest rates got up, the long bond got up to 15% compared to a 300-year previous high of 6.5% or 6%. So, and that again was due to policymakers being absolutely reckless. So it's been a fascinating time to be alert and aware in the financial markets, and we'll watch and see how this one goes. But to put the minus nominal in perspective is that in previous great financial bubbles, if you take the long interest rate in the senior markets, used to be London, now it's New York, and adjust it for the rate of CPI price inflation, the real long rates have declined with each financial bubble. And in, 3 instances, the yield actually went negative. And one of them, I recall, it was minus 5%, whereas the nominal rate in Germany got to not even minus 1%. So minus 5% has been clocked. And the key thing is that in real long interest rates, in the subsequent contraction, the long rate has soared. The typical increase has been about 10 percentage points. So whether and even then, there are some examples like 1929 where it didn't get negative. It just went down to low and then turned up, and we went through a grinding contraction with real long rates soaring, and no amount of buying of bonds by the Fed, which the Fed did buy bonds in 1929, 1930, 1931, 1932. The Fed was buying bonds like crazy, and it didn't prevent the contraction. So well, this is going to be exceptionally interesting, Jim, and we've had some nice questions.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. A headline that caught your attention. Rocket leads mortgage sector in GameStop-like short squeeze. They're short squeezing mortgages?
It's a mortgage company. I read about it, and they were doing complex things in mortgages. And the stock became a favorite, went straight up, and then now straight down, and heading to insolvency. So that's another one that'll be interesting to follow. In 1929, there was a promoter, speculator guy, Clarence Hattree, and he had, in that great bull market, had parlayed up quite a asset base, and he was going to take over an important steel company late 1928, going into early 29, and he had promises from various lenders that they would be there for when he would finally conclude the deal. And then it's going through, say, March, April, May, June. These lenders got cold feet and told him that they would not be participating. He knew that summer he was in deep trouble, and he even tried to get word through to the head of the Bank of England that if he fails, the market would go down with him, and that the bank should give him a special bailout. And that did not happen. And he did fail, and some writers did lay the blame on him, but no, that was a global bubble. And the problem with central banks in their lender of last resort concept is that they assume that only one company or bank goes bad at a time, and you fix that one and all's well. But they never seem to understand that in a speculative mania, in a bubble, there's many lending agency companies, banks, everything else become highly speculative, and then they actually all fail at the same time. So where somebody may say that if, as we go into a bear market, it was due to GameStop, or it was due to Rocket, or it was due to but no, they were just all participants within a massive speculative bubble. So again, this is going to be very fascinating to watch.
U.S. inflation is expected to hit a 10-year high. Why, Bob?
Yeah, well, they did a chart on that it was inflation expectations are at a 10-year high. And indeed it is. And this actually gets us into further nonsense by economists, is that they believe that, as I said earlier, that their expansion of Fed credit has a special characteristic that it drives the economy. But then, at various times, it will, and depending what the public chooses to speculate in, will inflate financial assets, or at another time, it'll inflate commodity prices. So then the way that and I use the term loosely, thinkers in economics described it, is that it was perfectly fine for the Fed to provide extra credit to the market. And if inflation in consumer prices and wages and commodities happened, that was due to the public's suddenly getting inflation expectations. So it's not due to the central bank depreciating the currency. It's due to a sudden arrival of inflation expectations amongst the public. And this chart just showed that whatever that measure was of inflation expectations, it was as high as it was back in 2008 when crude oil was up to $147 and blowing itself out. So what I take out of it, Jim, is that this is blowout territory, and this is just one chart showing that at the moment it's equivalent to what was accomplished back in 2008. So it's a good chart. It shows the warning, and this is where I thought we'd mention it.
And Fed head Powell confirms they will maintain their easy money policies. What does that mean?
They're nervous, my friend. To have a central banker in the height of an extraordinary speculation say that they're going to keep easy money is an attempt to keep the bubble going, because they know if the bubble quits, it's going to be a severe contraction. So, and here they are, and this is what happens at the end of every business cycle, even ordinary business cycles. All of a sudden, everything gets hot and speculative, whether it's real estate or housing or, in particularly financial assets, stocks and bonds. It gets hot. And the crowd rolls in, everybody gets long, and then it's the same old game. Who's left? When everybody's in the game, who's left to take it higher? Which is the greater fool theory. When you can buy a stock willingly going straight up, is because you're convinced that tomorrow there'll be another guy who will buy it even further straight up. So, and it's nicely been called for ages, generations actually, the greater fool theory, that you're a fool for buying a straight up market, but there'll be a fool tomorrow that'll take it even higher. And then this is where our technical analysis comes in, because it measures the excesses in the markets, and these have been very excessive speculations.
Janet Yellen, the new U.S. Treasury boss, that name's very familiar. She said the Democrats want to put a special tax on billionaires, but she has just said it's too difficult to tax billionaires. But Bernie, of course, wants to tax the 1%. Why is it too difficult to tax billionaires?
Oh, because most of them are Democrats. Bill Gates. The only one that isn't is Elon Musk, who heads up Tesla. He said some common sense things about politics recently and manias and stuff like that. But most of the billionaires, and particularly those in the media, Netflix and YouTube and Twitter and all this sort of stuff, they're all liberal socialists, and they have been manipulating the political attitudes for years, and people are starting to get fed up with it. So I think the truth of the matter is that if the Democrats were to come in with a wealth tax for that which is even a 1% one, obviously the billionaire Democrats have talked to the Democrat National Committee and said no way. So they're backing off on that. But of course, Bernie Sanders, the socialist, he's an independent, and actually he's had remarkable success in pulling the Democrat leadership to the left. It's been astounding. I can remember when Democrats were practical, and but now they're absolutely radical. So we'll see what happens. But the central bank, or this case the Treasury, and the central bank being accommodating is amazing. And then, as I said, the Yellen's speaking against the increase in the wealth tax. It's practical, but it's inspired by the billionaires.
And I was going to say, too, billionaire money is very elusive because much of their wealth is stored in tax-free foreign havens where you can't get at it. Or they just move. They just move to a new jurisdiction.
The actual invisible tax-free havens disappeared years ago. You just can't put your money into a Swiss bank and have it absolutely disappear. And you're in your name. No. They will, of course, anybody with wealth and income will attempt to protect that wealth from predatory governments and to reduce their tax exposure legally as best they can. But no, I think that's just straight Democrat billionaires talking to the Democrat leadership. No wealth tax.
Bob, thank you so much for chatting with us.
Yeah, Jim, we've had a pleasant Friday here together and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob and he loves to answer them, you can send them to info@howestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.